Okay, in the last session on strategic marketing, we were discussing about the concept of strategy as a journey, and in marketing terms it means it is about assessing our current market position using various tools like SWOT, strength, weakness, opportunity, threat analysis that we discussed, and going from that current market position, strategy is all about getting to the target market position. Now, what should be our target market position? How do we assess that whether that target is a feasible target, an achievable target? We have to look at various perspectives. Some of those we have discussed, and some more we will be discussing. That how do we know that our current position can lead to that intended position? There actually we have to look at concepts like the product life cycle and the growth rate, the industry position, and so on. We will be discussing all of that. But in assessing this strategic journey, as we discussed in the previous session, that there can be various alternatives. It is never one clear-cut linear plan. The marketing strategy must be flexible, it must be responsive to emerging situations, to that extent it must be adaptive, and therefore we need to assess at various points during the execution of a marketing strategy the cost versus benefit, the kind of budget that we will have to deploy to achieve our objectives, and if we achieve those objectives, then what kind of benefits will accrue to the organization as a whole. And therefore, as I mentioned towards the end of the last session, we need to be quite clear about that what are costs in a strategic sense. In the domain of marketing, we need to have our concepts clear. So, today's session, this session will be about understanding some of these fundamental finance management concepts, accounting concepts as they apply to marketing. So, on the left hand side, as you see on your screen, you have variable costs, and on the right hand side you have semi variable and fixed costs. So, in variable costs there are kind of two types. The column on the extreme left, these are costs which can be connected to each unit of product or service delivered to the customer, and so we often call it cost of goods sold. It can actually equally be applied to cost of service offered, and in this therefore there are issues like materials, labor, overhead, and all of these therefore we often look at in terms of per unit, which means if you sell 500,000 units, the material consumption will relate to those 500,000 units. If you consume, if you offer 400,000 units, then the material required will go down accordingly. the labor required per unit will go down accordingly, the total labor requirement will go down accordingly, and similarly overhead, that means attributable fixed costs per unit will also therefore go down or up according to the volume that we are looking at. So, we often call these as costs which can be calculated per unit. However, some of the other costs under variable cost may not be entirely relating to exactly per unit. For example, say sales commission. Sales commission is often provided according to, say, if you sell, achieve 70% of your target, then when the sales commission kicks in, or 80% of your target, and then you achieve a certain amount of sales commission between 80 to 100, then you achieve another set of a higher rate of sales commission maybe when you go 100 to 120 and so on and so forth. Or it sometimes can be given to volume, that means if you sell 10 to 50 units, then there is a certain commission. If you sell more than 50 units, then maybe a higher rate of sales commission. So, these are costs which cannot be exactly or often not exactly attributed per unit, but could be for a block. Similarly, discounts and the delivery costs, because often actually we can't deliver one unit. So, delivery costs are often calculated for a package which may contain 10 packets in a box, 50 packets in a box, and therefore, those costs have to be calculated accordingly. On the right hand side, we have semi variable and fixed costs. That means, these are costs, some of these are dependent on decisions that we can take, some of these are kind of dependent on our discretion to that extent. Therefore, how much we are going to spend on advertising is not entirely fixed. We do have some control on it, or how much we are going to, what will be our promotion cost, or for example, fixed salaries of sales and marketing people. Again, here it is somewhat variable, because you could have some control on the total number of such people you will deploy. And then there are some costs which we call committed costs, like for example, rent of sales offices or warehouses, or administrative costs. These are again not entirely not completely fixed, but again they are committed for 6 months, 1 year and so on, depending on the terms of business. Then there are some other marketing costs. These are expenditure that are expected to occur in the future as a result of some marketing action that you are taking today. And obviously, marketing costs differ depending on which alternative you are choosing in your this going from current position to your internet position. So, there can be a plan A, plan B, plan C, and each one will have certain type of marketing cost. As we had discussed in some earlier session, that the marketing effort changes across the product life cycle. So, while in the initial stage of the product life cycle, it is far more explanatory, information, knowledge transmitting activity between the company and the customer, and lot of direct selling expenses may be involved at that stage, lot of exhibition, promotional seminars, road shows may be involved. So, marketing costs can be higher on those counts in the initial phase, whereas at the later stage in the product life cycle, the marketing costs could be related more towards service or customer relationship building and so on. So, different plans at different points of time, at different points on the product life cycle, depending on the company's current position, all these marketing costs, the composition of the marketing costs will differ. And then of course, we should never forget, sometimes we tend to ignore this, that by adopting plan A, we are giving up certain opportunities which may be enshrined in plan B, and therefore, some of those opportunities costs also must be counted at certain when it is very significant. Then there are costs which we often call sunk costs. That means once committed, it is gone. That means, say, what has gone into as research and development for developing a particular product, that's already, in a way, it's a marketing cost, because it's a cost of bringing that product into the market. But to that extent, you know, it is not per unit, it is not controllable today, because it is a cost that we have already incurred. Similarly, all new product launches need some kind of testing in the marketplace before we go for a full-fledged launch, and therefore test marketing costs are often considered as sunk costs. Similarly, certain pre-launch advertising expenses may also be counted in this category. The sunk cost often is seen as a fallacy or a trap, because in a way you first spend money to develop a product, to promote that product, the pre-launch promotion and so on, and to recover that money you actually have to spend more money by way of your post-launch promotion, your product life cycle based marketing expenses and so on. So, often actually sunk costs are, they kind of breed more costs in terms of marketing efforts. Now, we will like to discuss few of the fundamental concepts. I expect most of you already know these concepts, and but it's good to recap them before we go along to the more deeper and complex topics. So, margin, you all know, it's the difference between the selling price and the cost of the offering, which means it could be, we have used the word deliberately as offering. That means it equally applies to unit of product or unit of service. It is expressed on a total volume or individual basis in rupee terms or as percentages. We will see that just now. So, a quick quiz for you. So, gross margin, we have question mark, trade margin, profit margin, right. So, what should we put at this? So, obviously, I am sure most of you will be able to answer this. Yes, gross margin is equal to, and this is plus. So, gross margin is trade margin plus profit margin. What is gross margin? Is the difference between the total sales revenue and total cost of goods sold, and that means we are not considering at this stage often costs like the cost of money or what we call interest cost and tax and so on. And gross profit can be per unit basis, in which case it is the difference between the unit selling price and the unit COGS or cost of goods sold. I am sure you are already familiar with these terms from your previous understanding. Let us take some quick understanding of numbers. If the net sales is 100 and cost of goods sold is 40, then the gross profit margin is 60 and it represents in percentage 60%. Unit sales price 1, if the unit cost of is 40 paise, then we have 60 paise per unit as the unit gross profit margin, again that same 60%. Okay. Now, this is an important point, that a decrease in gross margin can adversely affect profit, and often actually when we look at this, for example, that suppose you give a 10% discount, right, on your unit sales price, then your new sales price will become 90 paisa, 0.9. This does not change because you have given a discount, your cost is not going to change. So, this becomes 0.5. Now, you see the difference between 0.6 and 0.5 is almost 20%, depends on how you look at it. If you look at from this side, it is now that means the difference of 10% can lead to a 20% difference when you look at your profit margin. So, this is a very important point to understand that a discount at the sales price level can look innocuous, but it can be significantly magnified as a reduction in the gross profit margin. Also, obviously, if there is a fluctuation in unit volume or changes in unit price, unit cost of goods sold, modification in the sales mix, all of these can change the gross margin, gross profit. Trade margin, the difference between the unit sales price and the unit cost at each level of a marketing channel. So, as you know, most of the time if we look at most of the fast moving consumer goods like soap, toothpaste or shampoo, some of the examples that we have been discussing, they go from manufacturer to the wholesaler to the retailer. Okay. At each stage there is some sharing of margin, and this is often called as markup or mark on by channel members. That means and it is expressed as a percentage. Let's look at some example in this. Now, here you see that if the margin is 10, that means your selling price is 20, your cost is 10, your margin is 10, then the margin is 10% of the cost and margin is 50% of the selling price. Okay. Some of these concepts should be absolutely clear. They look very simple, but we can get quite confused when we look at some of the financial reports that marketing managers often need to analyze. Trade margin, on the other hand, is often based on selling price. So, let us look at that. We often actually look at a product and its MRP or the maximum retail price, and so we look at a soap which is 45 rupees when you buy. The marked price, the MRP may be 50 on that, and the retailer might tell you that I am giving you 10% discount, but in reality if that is 45, the retailer in most probably got it at 31.25 and he is selling at 45. So, his margin is something like 30%. Now, if the retailer has received it at 31.25, the wholesaler most probably would have got it at 25, and then which means the wholesaler is actually keeping a 20% margin. If the wholesaler got it at 25, then the manufacturer, perhaps the manufacturing cost or the what we often call the cost at the factory gate might be 20. So, you see here that the manufacturer actually gets only 20% and is 50%. So, to get to the margin map, you have to start from the end, that means the price in the consumer's hand, go from there the price at which the retailer was able to get it from the wholesaler, and the wholesaler the price at which they were able to get it from manufacturer. And as you can see, therefore, because of this distribution chain, something that actually the manufacturer only gets 20 or rather 25 against the 20 reaches you as consumer, in your hand it becomes 45 and the marked price may be 50. Okay. So, this understanding is very important. Now, one may think that why not we therefore jump and go from 25 to 45 or 25 to 50 if we can, and why do we have to share these margins, right. Now, this is again today 30 years back, 50 years back, this was not a debate, because to reach out from your manufacturing location to customers all across the geography, you needed a vehicle, you needed a mechanism to get there. And it has been well calculated that if the manufacturer had to take the product or product basket by the company to the customer, the costs are often quite high, whereas a wholesaler or a retailer can distribute his or her overhead over a larger basket of products, and therefore, it is more economic to use the distribution chain. Today, however, because of the electronic market potential, the e-business or internet commerce, it is possible, it is tempting that one could look at reaching the customer directly from the from this point onwards. Now, obviously, that means that a company which is able to do that, or products where this philosophy can be, or this concept can be applied, the manufacturer's ability to compete goes up. And often, and in this respect, one has to look at the great example of Dell. They were the first PC, personal computer vendor, who decided to do most of their business through the virtual distribution chain. That means they relied from the beginning heavily on telephone based, internet based, direct selling from their manufacturing or distribution location, and they did not have distributors and retailers as were used by many of their competitors at that time. As a result, Dell had a greater competitive depth because they had lesser amount of sharing, lesser amount to share as margin with their channel partners, because they had no channel partner. It was almost a direct reaching out to the customer. And for many years, it was a very significant advantage, and so gradually they were able to edge upwards, and soon they became number one in that market. And even though they are competitors like Compaq or HP or IBM and others, they saw that this was an obvious advantage which Dell had. They were not always able to emulate that example, because they already had a very significant distribution chain, long term relation with their distributors. They needed their distributors for other products, and therefore, they could not actually get into that situation which we call often channel conflict. So, knowing fully well that the Dell model gives a lesser sharing and elimination of trade margin almost entirely, and therefore, a more enhanced marketing power, and the competitors were not able to emulate that because of the legacy they already had, or the structure they already had. So, this was a short discussion about trade margin and what it does to your competitiveness or to your marketing strategy. So, trade margins are important considerations. There are costs, but there are benefits. If you can find an alternative route as Dell found, then fine, but in most cases, particularly in a far flung country or when you go into a global scenario, you often have to have sharing of your total margin, and there has to be an accounting for trade margin. So, this is a typical income statement, as you see here, that if the net sales is 100,000 rupees, cost of goods sold 30,000, gross profit margin 70,000 or 70%, selling expenses 20,000, fixed expenses 40,000. These are you remember that some of the expenses that we saw, and therefore, you have 10% or 10,000 rupees on 100,000 rupees as your net profit margin. This is very important, this margin, that if you are able to push this up, and if you which means that if you either you are able to reduce your cost in cost of goods sold, that means you are able to work well as a marketing team with your operations team, and therefore, you are able to bring the costs down, cut out the frills that are not truly appreciated by the customer or are not that significant in the customer's perception. So, this continuous partnering between the marketing team and the operations team can lead to, and if you are able to decrease this to say even 25,000, right. So, your costs are coming down just by 5,000 rupees, but you see this will straight away push up your final result to 15,000, which is 50% improvement, right, because this is now becoming 75,000, and 75,000 minus 60 is 15,000. If your selling expenses, like we were discussing about reduction of trade margin, if you could utilize more of electronic distribution, again can make a significant. So, 5,000 rupees decrease in COGS can lead to 50% increase in your profit margin. And if you have higher profit margin, you are able to improve your working capital because you have a better ability to pay COGS. If you have a better ability, you can get better terms from your vendors. So, it creates a virtuous cycle here, because the higher ability you have to pay your salespeople, you get better salespeople, and overall your cash flow position improves. Okay. So, important, profit is the lifeblood, the margin is the lifeblood of the business in this scenario. The next important concept that we will discuss will be break even, and break even is derived from this total revenue is obviously total variable cost plus total fixed cost, and again I am sure you all know about this, how to calculate the break even volume or break even price and so on. So, but before that you need to have good estimate of unit variable costs and an estimate of the total fixed cost which is relevant, and the selling price for each offering unit. So, then what happens? This is how we calculate it, the total fixed cost divided by unit selling price minus unit variable cost unit variable cost. So, that gives us the denominator is the contribution per unit, unit selling price minus unit variable cost, and this is equal to rupee amount that each unit sold contributes to the payment of fixed costs. This contribution, that is why we call it contribution, because it contributes to the payment of fixed costs. And then we can apply some numbers that suppose your unit selling price is 5, unit variable cost is 2 rupees and total fixed cost is 30,000. So, 30,000 divided by 5 minus 2, it means equal to 3. So, 10,000 units you need to sell to recover your 30,000 rupees fixed cost, 10,000 units at the rate of rupees 3 per unit of recovery. Okay. In the same way, we can look at it, this was actually we looked at this in terms of numbers, units. So, this we call break even volume in units, and break even volume in rupees will be unit selling price multiplied by the unit break even volume. So, that means 5 rupees is the selling price multiplied by the 10,000 that we just obtained. So, 5 rupees is the, so 5 into 10,000, that will give you 50,000 rupees, which is your break even volume in rupees. So, contribution margin is we discussed a while back, is unit selling price minus unit variable cost upon unit selling price. So, that kind of gives you as a percentage. So, 5 minus 2, you remember the 5 rupees was your selling price, 2 rupees, and therefore, your contribution margin is 60%, 3 upon 5. And rupee break even volume is often equal, can be also obtained by total fixed cost divided by contribution margin in percentage. So, 30,000 divided by 0.6 gets you that same 50,000 that we obtained by this other method. Okay, 50,000. This we got from unit selling price multiplied by the break even volume, and same 50,000. So, therefore, we can also look at it graphically, and that is, this is the fixed cost line, it does not change, is not dependent on unit volume. The variable cost, right, it changes, it comes obviously after the fixed cost, because the fixed cost is there whether you produce 1 unit or you do not produce anything, or you produce 500,000 units, of course within a limit, because there is a concept of capacity. So, as long as whether you are within the production capacity or the capacity operational capacity, so it does not, the fixed cost does not change. So, it comes on top of that, right. So, the variable cost and this together can therefore create this total cost line, and we often say that the break even point is where we reach this either trade 10,000 the unit volume or the total revenue. And as you see here, this is the point where total revenue and total cost, these two graphs they intersect. So, break even means that is where your total revenue has just about met your total cost. What is very interesting is after you cross this point, why are we so bothered with this point, is that after this point everything, every bit is actually your profit. So, your contribution at that point onwards goes totally to the profit. Before that, the contribution goes towards meeting your fixed cost. The other very important point is that if we are able to bring this down, that means if our break even volume instead of 10,000 unit becomes 5,000 unit, then we are able to gain significant marketing flexibility, which means that we can preserve our resources, we are able to then the risks come down significantly, and therefore we can also plan our marketing budget, so we can get a bigger bang for our buck, as they say. So, whenever we look at a new product or any new marketing plan, it is very important to be very clear that what is the impact of that marketing plan on your break even volume, because as you can see, some of those costs will increase your fixed cost, right. If you open new offices, if you hire more number of marketing or sales people, if you actually commit yourself to a big campaign, all of that in a way have already created costs which are not attributable to each unit in a way. That means, whether if you go for a big promotion, whether you sell 100,000 units or you sell only 50,000 units, it is going to be that cost is already committed, and therefore you need to sell more to recover that committed cost, and that is the fallacy or the trap of the sunk cost, and that is why it is very important to always plan for a break even volume which is as low as possible, which means if we can keep our fixed costs low, or if we can improve our margin or contribution per unit, our marketing plan will be will have strategic advantage. We will continue this discussion once we look at few other concepts. Thank you.